Welcome back to Markets Today. If you are just joining us, we have a continued conversation with regards to the impact of the rate cap on different sectors in the economy. To start us off, we are looking at the real estate sector. This is a sector that has seen lower yields, a sector that has seen people say that there is a bubble and it's bound to burst, a sector that has seen people say that there's actually an oversupply with regards to either commercial or retail units, depending on where you're looking at. Now, the question we want to answer today, the rate cap has been repealed in totality. Is this a positive for the sector? Do we expect the banks to start extending credit into this particular sector? And for you, as an investor or a possible buyer for an asset in this field, is there an upside for you from here on? And what should your considerations be? With us in studio, we do have Wacu Mbugua, who is a research analyst at Cytonn Real Estate. Welcome to the show, Wacu.
Thank you for that.
So what are your considerations? The rate cap has been repealed in totality. That should affect future loans. What does that mean when you're looking at real estate, and what are your key considerations at this point in time?
Well, we in the sector are actually happy that the rate cap law has been repealed, because for the past 2 years, or 3 actually, since around 2016 when it was put into effect, access to finance has become a major challenge for the real estate sector. And obviously for the entire economy. It has had more negative effect than benefits. So in terms of the real estate sector, we've seen financial constraints for the buyers because they cannot be able to borrow from the banks who used to prefer investing in government securities because borrowers are considered high risk or something. And then it's still the same case for developers. And so there's been a lot of finance issues, and that has obviously affected uptake of properties. There's some time back we saw a lot of auctions, a lot of properties being returned to the market because the borrowers or the end buyers couldn't finance their mortgage repayments anymore, and that's because they didn't have the money, and that's because the private sector credit growth has been very low since the interest rate cap.
So for you, at the initial, it's bare minimum, it's certainly a positive for this sector.
Yeah, it's definitely a positive, because now we expect that lending institutions will be able to offer more credit to the population, and then they'll be able to, it will increase their spending power.
Increase spending power in an economy that is highly dependent on debt for consumption. Now, let's understand the existing environment. So for the last 3 years, very minimum credit going into the sector, which has meant developers have had to be slightly smarter with regards to fundraising. But how does the real estate sector look today? Is there an oversupply with regards to units? What is happening to yields? What is the overview, even before we touch on the rate cap environment?
Okay, there is actually an oversupply, especially in sectors such as office, in some nodes, not all nodes. There is an oversupply in retail, also in some nodes, and then in residential, we're seeing a bit, not really an oversupply, but the supply that is there in the high end to upper mid markets is a bit more than what is the demand that there is. And the reason for the oversupply is not really, I don't think it's connected to the interest rate cap, because construction takes like a 2-year lag, and the oversupply started about 2017. So you can say these are projects that maybe started in 2014, 2015, and then now once they were completed, by the time that they were being completed, the economy wasn't as stimulated because of the interest rate cap law. So we've seen people not taking up the space that is being provided. For office sectors, areas like Upper Hill, CBD, we've seen a lot of oversupply, and we're seeing companies moving to areas that are less congested, areas like Karen, where there isn't the supply is just at a good rate, areas like Giri, where there isn't a lot of supply. In terms of the retail sector, there's also a bit of an oversupply, and that I think it's really connected to the consumer spending power, because if people are not going to malls, then the mall tenants won't be able to pay their rents. And so we've been seeing a lot of closures, especially within malls. And I think now that the rate has been repealed, obviously the spending power won't increase like instantly, but we're hoping the sector will start to improve.
Interesting. So an oversupply with regards to commercial property, with people opting to move out, and also the element or the trend that's catching on with regards to shared space, where you want flexibility with regards regards to when you use the space, and then also the trend of people working from home. So that's becoming a thing and reducing to an extent the demand for commercial spaces. Now let's look at the retail sector. I know there's the top end. You know, that's your runda and maybe bigger houses, and then the apartments in the middle income levels, and then the apartments in the lower income levels. Let's look at the apartments. What's the trend? Because we do see people now building more of 2 bedrooms, 1 bedroom houses as opposed to 3 or 4 bedroom houses. What is happening in that space?
So in the residential sector, obviously the high-end markets and the upper mid-end markets, mostly the clientele is the middle class and maybe the foreign expats. But actually, even the economy is not just dull in Kenya, it's a global thing.
It's nothing.
Yeah, so there's all these factors. There's the interest rate cap law, and then there's also the global economy, which is not doing as well because of all these geopolitical risks. And so we've seen even multinational firms scaling down on their operations, and then those expats are now moving back to their countries or they're moving elsewhere. Recently, there's a Coca-Cola just moved their operations to South Africa, and we've seen a lot of other firms doing that. And so these people are the people who buy houses in Runda or areas like Tisuru, and so now those houses, the high-end markets. And so now we're seeing a lot decline in occupancy rates and decline in uptake. However, within the Kenyan market and within the Kenyan clientele, there's this issue of affordability. So with all the job losses, the economy not doing so well, tough financial environment, people care more about affordability right now, be it in residential and even in commercial. So like in malls, we see like the most expensive spaces are on ground floor, and others are, as you go up, the space becomes more affordable. So me as a business, rather than go to ground floor where I can get more clientele, I would rather risk it and just go to where I can afford and be able to sustain it. In the residential sector, we're seeing people now moving to far away areas from their workstations and be able to sustain their rents or their mortgage payments, because the houses in, say, areas like in satellite towns, say at the river, Thika, Ruai, such areas, Kiambu, are more affordable, but you end up paying more in terms of commuting time and also a bit more of transport. But when you combine them, it's still more affordable than living in an area that is close to your workstations, because these areas are pricey. They're priced.
So fair enough. So it looks like there's been a sort of a slowdown, a near standstill in the real estate sector. This capacity has come on board from projects that were sanctioned before the rate cap environment and have come to completion. But then now the offtake and demand and affordability of these opportunities is not rife, at least before the rate cap environment happened. Now we have a situation, the rate cap is no longer there. And there's the hope that maybe now the banks can be able to price the risk affiliated with different sectors, for example, the real estate sector. And that could in a way enhance offtake of these assets. What are your initial thoughts on it? Do you expect demand to shoot up overnight? Is it going to be gradual? And what are your thoughts on yields? But let's start with demand and the outlook for demand in a zero rate cap environment.
Okay, I think in terms of demand, I'm not sure if it will pick up like overnight, or I think it will be more gradual.
Okay, so gradual.
Yeah, because I don't think banks will decide to, oh, now the interest rate cap law is no longer there, so let's give credit to everyone who wants it. So I think they'll take time, especially right now. I think people at this point, they have more debt repayments to cater for. So I think once that is leveled, now banks can, and people become more credit worthy. I think now they'll be able to take on more credit to finance their purchases, their property purchases and all that. What is the other question?
Okay, no, that's okay. That's a good one, because I think what you're saying is we're coming from the bottom up. So you cannot start at the valley and in 1 second get to the top of the mountain. So that's expected. So expect a gradual shift with regards to demand. What about the yields? We have seen the yields not topple down, like really come off in different sectors. What are your expectations? Say, for a house now in Ruaka, what's the outlook for a house in Ruaka, maybe a house in Runda, where you're looking at the high end and middle income
I think now yields are especially very stable and relatively high when you look at lower mid-end markets, because now at this point when people cannot be able to buy a lot of properties, they're instead choosing to rent these properties. So the rent market is it's doing well right now. And so if you can, and especially for the past few months, we've seen a lot of developers offering price discounts to attract clientele. So it means you as an investor, you've been able to buy this property at a subsidized
if
price.
you could afford it,
yeah, if you can. But if you are an aspirational real estate investor and you had some, say, 10 million to spend, if a property somewhere you are eyeing was going for 13, 15 million and now it's going for 10 million, then you can be able to finance that project and be able to attract. Right now that the common monarchy is opting for the renting market, so you're able to get an occupant faster. And with that rate, with the normal rents and the subsidized price, then this means that the actual yield is actually higher compared to when prices are, you know, are at a market average. So pricing discounts and rents, they work well for the rental yields. And then now that people are moving in drives to the low-end neighborhoods, now rents are actually increasing in those areas.
So there's more upside in the satellite area. So the likes of Wacu, Rongai,
rents are increasing, but not that they're increasing to the level that they're not affordable. These areas have always been affordable, so it's a gradual increase, but it's still affordable to the middle income earner, to the lower middle income earner, and such. And I think right now that the interest rate cap law is being repealed, it has been repealed. I think people are very hopeful right now, and maybe we might see now asking prices and asking rents maybe now starting to increase, because the reason that they were decreasing and the reason that developers were giving discounts is because everyone was pessimistic about the economy and all that. So now that there's hope that the economy is going to be stimulated and it's going to get better, maybe the asking rents and the asking prices are going to, you know, just increase.
Okay, so
and
just,
all
all right, interesting.
Yeah.
All right, let's just take a short break. The Nairobi Securities Exchange has closed. Look out for the closing bell and don't go anywhere. We'll be back shortly.